Warren Buffett didn't invent a smartphone, launch a social network, or sell a futuristic dream. He built one of history's greatest fortunes with something far less exciting: patience. While other people chased the next big prediction, Buffett quietly read company reports. Not exactly Hollywood material, but his bank account probably didn't mind. He bought his first stock at only 11 years old. 3 shares of City's Service Preferred at $38 per share. The price quickly fell. Imagine being 11, watching your savings shrink, and learning that the stock market has absolutely no sympathy for children. When the shares recovered to $40, Warren sold for a small profit. Then the price kept climbing, eventually teaching him that selling too early can be expensive. That lesson became the foundation of a much larger machine. Buy productive businesses, keep their cash working, and let every successful decision help finance the next one. Growing up in Omaha, Warren delivered newspapers before most people finished breakfast. Every route taught him that small, repeatable profits could become surprisingly meaningful. He sold gum, soft drinks, and newspapers, then recorded every cent. Other teenagers collected baseball cards. Warren collected tiny cash flows. At Columbia Business School, Benjamin Graham taught him to see stocks as pieces of real businesses, not flashing symbols designed to raise your blood pressure. Behind every share were factories, employees, products, customers, and future profits. Buffett learned to study the business first and the market's mood second. His early strategy was simple: find companies selling for less than the value of their assets and demand a margin of safety in case the analysis was wrong. Graham called some of these companies cigar butts, discarded businesses with one profitable puff remaining. It was effective, although not exactly a glamorous shopping list. In 1956, Buffett formed investment partnerships with money from family and friends. They trusted a 25-year-old who mostly promised to avoid doing anything foolish. Strong results attracted more investors, but Buffett remained focused on reports, balance sheets, and disciplined decisions. The office grew faster than his appetite for luxury. Then he discovered Berkshire Hathaway, a struggling New England textile manufacturer whose stock looked cheaper than the factories and equipment behind it. On paper, Berkshire appeared to be a bargain. Buffett believed he was buying valuable machinery, inventory, and property at a generous discount. But the textile business constantly demanded new machinery just to remain competitive. Cash entered the factory like a guest, and apparently forgot where the exit was. Buffett eventually accepted the mistake and redirected Berkshire's capital toward stronger businesses. The failing textile mill became the shell of a very different company. One of Berkshire's most important moves was entering insurance. Insurers collect premiums today, while many claims may not be paid until years later. The money held during that waiting period is called float. It doesn't permanently belong to the insurer, but it can be invested until claims become due. Float is only valuable when insurance risks are priced carefully. Bad underwriting can turn temporary capital into a very permanent headache. Charlie Munger pushed Buffett beyond merely buying cheap companies. His better question was, why not own an exceptional business at a sensible price? A mediocre company may look inexpensive, yet consume cash forever. A great company can earn more, need less reinvestment, and reward its owner for decades. See's Candies proved the point. Customers loved the brand, returned every holiday, and accepted reasonable price increases without staging a chocolate rebellion. The candy business generated more cash than it needed. Buffett could move that excess into insurance, manufacturing, energy, railroads, or another productive investment. This is compounding on a corporate scale. Profits purchase assets. Those assets create additional profits, and time turns a small snowball into something enormous. During market crises, Berkshire kept liquidity available. Buffett didn't need to predict the exact bottom. He only needed the strength to act when others couldn't. His billions did not come from an enormous salary. They came from ownership, a long-term claim on the cash produced by Berkshire's growing collection of businesses. Buffett still made mistakes and missed major opportunities. The system never required perfection, only avoiding catastrophe and giving the best decisions enough time to matter. Insurance created float. Float supported investments. Great businesses produced cash, and that cash purchased more productive assets. Warren Buffett didn't simply build a portfolio, he built an engine, then gave it decades to run. This video is for educational purposes and is not personalized financial advice.